The views and opinions expressed in this broadcast do not necessarily reflect or represent the views and opinions of WBGR Network.
Welcome to Let's Talk Money 2020. This is October the 16th, very historical day. This is the 25th anniversary of the Million Man March. I was there myself. Wonderful day, great day, one of the best days of my life. I spent earlier today kind of watching the film. They were showing the whole march again today, so I'm in the middle of it now. So I want to talk about a few things today that are very important for business owners that we kind of overlook. And a lot of times we just don't know about certain things. But yesterday was the end of the official tax season for individuals. So one thing that I did notice is there were some clients that came to us that did not understand the concept of annual filings. Now, I'm not talking about income taxes. I'm not talking about, when you send off your 1040 or your business returns or that sort of thing. I'm talking about the annual filings when you have a business and it's registered at the state that you reside in. We're in Maryland, so I'm going to talk more about Maryland things. Maybe in the future weeks I'll break down other states, but I only got a certain amount of time, so I can only talk about just Maryland, the stuff that I really know, and you can really just translate it over to your particular state. But when you form a state, not when you form a state, that would be nice, but when you form a business, what you have to do is you have to register that business at the state level, and we all kind of know this, right? And then once you register that business at the state level, you can get a federal tax ID number. So most of the times you can go online and kind of register your business, or you can pay somebody to start your business for you, or you can basically go into your corporate office at your particular state and really just form your own business. So once you do that, there are requirements that you have to do year after year, or it might be every 2 years. It varies from state to state, but you have to do these annual filings. And the state, especially Maryland, they're not as, I guess, aggressive of reminding you that you have to do these particular filings. They kind of act kind of retroactively, where they wait until you miss the deadline, and then they start sending you notices, and they might send you notices 4 or 5 months after the fact. Or if you moved or something, you might not ever get the notice. So what'll happen is you'll go a few years in your business, and then you go and you try to get open up a bank account somewhere, and the bank wants to see your corporation papers, and they want to see that you're in good standing. And that's when you realize that you didn't do what you were supposed to do every year by doing the annual filings, or in your state it could be every 2 years. But that's when you find out that you're behind on things, and they won't even open up the bank account, the business bank account, for you unless you're in good standing. Or you go to get a government contract or some other type of contract, and they want to see that you are in good standing with the state that your business resides in. And that's when you find out, oh man, I missed all these years of doing this annual filing. I didn't know about the annual filing, or my accountant failed to do it, or I just forgot to do it. I got the paperwork, but I just forgot to actually send in the filings because I got it confused with the income taxes. But it's not an income tax, and most states have these things, believe it or not. So I want to talk about the annual filing, because it does have serious repercussions if you don't actually go through with the filing. So let me just go on and start here. Give me a second here. All right, here we go. So the annual filings, it can be called a number of different things in your particular state, right? It can be called annual reports. which in Maryland we have an annual report. They can be called biannual reports. So in DC they have a biannual report, and when I look at other states, some states have biannual reports where you pay a fee 1 year, then you wait 2 years to actually file the reports and pay a fee in that second year, and it goes every other year. And then you have some states that just have strictly personal property tax returns. Maryland basically combines theirs. They have an annual report and they have a personal property tax return, and I'll get into those things a little bit later. DC has what's called an arena tax, so there's arena tax forms, and I think they go to really funding the arenas and stadiums and that sort of thing that they build in that particular jurisdiction. But again, I'm not talking about the income taxes. I'm talking about the annual requirements that you have to do in the state in which your business resides in. So what it basically does is give you permission to actually do business in that particular state. So if you are located, say, in Maryland, then you are a Maryland corporation. But if you say you're a Delaware corporation, but you want to do business in Maryland, you are really a foreign corporation, not foreign in the international sense, but you are a foreign corporation to Maryland. So to conduct business in Maryland, you're listed as a foreign corporation or a foreign company. And that has anything to do with international territory or anything. It's just you're foreign to the state of Maryland. So it really just gives you permission to conduct business in the state of Maryland. And also, it's a way that we kind of assess how much you should pay in personal property taxes. And I'll get to that in a minute. So, I think I went backwards here. All right, so here's the purpose and how the process actually works in the state of Maryland. So, like I said before, there's a tax on the tangible property, personal property that you have in the business in the state of Maryland. So, you can either own the property, you can use the property, or you can rent the property, right? But you still have to pay the estimated tax on the value of the property. So, what happens is that tax is really a county tax. So each county has its own rate, right? So every business has to report. So they report to a central place. So they report to Baltimore what your assets are. So regardless of what county you're in, you report what your assets are. You purchase assets, and you have to report those assets to the state of Maryland. And what the state of Maryland does is they put that information into a database, and depending on the county that you reside in, they send your assessment to the county. So this is how it works. You fill out a personal property tax return for the state of Maryland, send it to Baltimore. They look at the assets, they put those assets in the system. And then they actually, you get a bill from the county in which you reside based on the value of the assets, and those assets are depreciated every year. So it won't be the same amount every year. Hopefully it goes down every year unless you're purchasing more and more assets. So again, it's a county tax, but the $300 that you pay the state of Maryland every year when you actually fill out the personal property tax return, that $300 is to actually process recording your assets for the year and then sending those assets down to the county. So that's what you're paying for. I used to call it the $300 mafia tax, because if you're a business in the state of Maryland, you know you have to pay the $300 to the state of Maryland, and then after some time goes by, you get this bill from the county. Well, that bill is the assessed value that you gave Baltimore. So that's why it's important to put the right county on that personal property tax return. So these are the fees, and again, in Maryland it's $300 a year, but some jurisdictions it might be $50 a year. It might be some other fee, but I noticed that throughout the country, their fees range from $50 to $300 a year. So again, Maryland is $300 a year. So if you're a business, any type of business that you have in Maryland, you have to fill out this personal property tax return. Okay, so there's basically, I kind of already said this, there's two payments each year. There's the $300 that you pay the state of Maryland, and then there's the assessment that's based on the assets that you reported. That assessment is by the county. All right. So the taxes on personal, on tangible personal property. All right. I'm going to define that in a minute. But if you own the property, rented the property, or use the property, you have to put on the form whether you've done one of these things with the property, and then you have to give the value of it, and then you're taxed on it. Okay, so when is it due? It's due on the 15th of April, but you can get a 3-month extension in the state of Maryland just by going to the SDAT website. You just Google SDAT, and then the SDAT website pops up. You go to the business entity search, where you go to the business page, put it that way, and then you'll see something there saying to extend your period for filing the personal property tax returns. Click this link, and then you get a 3-month extension. And once you follow the links, if you don't have any income, then you still must file. That's one of the misnomers, that if you registered the business, however, you're not doing anything with the business. It happens a lot. You're trying to get yourself together, trying to think about how you're going to conduct business, but you went ahead of yourself and you started the business without even actually being in business. I see it all the time. But if you don't have any income, you still have to file the personal property tax returns. Even if you conducted no activity, if you want that business to continue, you have to actually fill out the personal property tax return and pay them the $300 anyway. All right, so I keep going backwards. So who is required to file? If you're a corporation, if you're a sole proprietor, believe it or not, although sole proprietorships, you can kind of get away with it as long as you stay under a certain size. But if you are a sole proprietor, you really are supposed to register and really pay the self-employment tax. I'm not the self-employment tax, sorry, the personal property tax. The LLC, if you're an LLC, S corp, these are the businesses that actually pay the $300 a year. But if you're a nonprofit, a religious org, then you have to do the filing every year, but you just don't pay the $300 every year. So make sure that you stay on top of that, because you can make sure that you actually renew your nonprofit every year by doing the federal requirements and any other type of requirements. But if you don't do the personal property tax return, your business could be, or your nonprofit could be, forfeited in the state of Maryland. So you don't want that to happen when you could just file the paperwork without the fee. You just have to make sure that you actually send in this paperwork, send in the annual return, the personal property return every year. It's a little bit easier if you're a nonprofit. You don't even have to list the assets if you're a nonprofit. One requirement that they do ask you for is if you file a nonprofit tax return every year, which is a Form 990, they would like for you to attach the 990 to prove that you still are a nonprofit organization to your annual personal property tax return. So make sure you do that. Don't forget about those things, because they're very, very important. What is personal property? What is tangible personal property? I'm going to tell you the easiest way that I know is to really describe what is tangible personal property. You hear the term all the time, and you might say, well, what is that? Well, the way I explain it is, it's any property that does not become part of the real estate. So if you renting an office, for example, and you have fixtures that are mounted to the wall, that's not tangible personal property, because it's not easily detached from the wall, right? If you have chairs, desks, whatever, if you were to leave the office, if you got another space somewhere else, you can easily pick up that chair and put it on a truck and just drive somewhere to your new office, right? That will be that will be tangible personal property taxes. If you got a phone, computers, anything in your office that could be removed. Now, if you laid the carpet, just suppose you laid the carpet, and when you leave, you don't intend on taking the carpet. Well, the carpet is not tangible personal property because it's affixed to the real estate. So that's the way you want to look at the definition of tangible personal property. Now, one thing that is not included in tangible personal property is your registered vehicles. So I think I'm going to talk about this a little later, but I'm going to jump the gun a little bit. But if you have a registered vehicle, like your car that you drive every day, that's not a asset that you put on the personal property tax returns. And I've seen people make this mistake. They're overpaying the personal property taxes because they're putting the company vehicles onto the personal property tax return. Don't do that. It says it clearly in the instructions. If you just read it, it's not that obvious, but if you just keep reading the instructions, it's right there. If your car is a registered car vehicle that really really travels on the road, then there is no you don't have to pay any taxes, any personal property taxes on that. But if it's a vehicle that is not a road bearing vehicle, like a Bobcat or something like that, then you have to pay the personal property taxes on it. So make sure you're aware of that. All right, so I'm jumping ahead again a little bit. So registered vehicles again are not they are not taxable properties. They're considered exempt properties. Properties owned by a nonprofit or religious organization, they are exempt properties as well. Now, one thing I want to talk about is the rates. Remember, I said the rates are defined by the county in which your business is in. So every county has its own rate. So if you're located in multiple counties, you could have multiple rates when it comes to your personal property. So you have to let the county know, well, this chair is in Anne Arundel County. That chair is in Prince George's County. And if they have different rates, then you're going to have different calculations you could have different calculations for the same type of chair. So let's move on. So, if you have no property in the state of Maryland, then the form is just a little bit easier for you. The form is really broken out into two parts. It's an annual return, and it's a personal property tax return. So, if you don't have any property in the state of Maryland that you're actually making money off from, or you're not using it in the course of business, you check a box saying no, I don't have any personal property taxes that I'm using in a business, then you don't have to fill out the personal property tax form. So the form gets a little easier. You just have to do the annual filing, but the annual filing does require you to actually pay the $300. Even though you had no income or you don't necessarily have assets in the business, you just have an idea, you started the company, you registered the company, and you don't have any computers, you don't have any chairs, desks, whatever, you don't have any property in the business, then you only have to fill out that one form. Now, I do want to say one thing. If you have things like inventory, that's not considered personal property that's taxable in the state of Maryland. So if you have inventory that you sell to your customers, that's not considered personal property. So don't make a mistake and put that into the calculations that will actually go towards how much you pay as far as the state taxes are concerned. You do have to list your inventory on the form, but make sure you put it in that inventory section. Don't put it in a section where your computers, your desks, your pictures, your telephone systems, and whatever. Don't put it in that same section, or else you're going to be taxed on it. And once you put it in that section, I hate to say this, but once you put it in that section, the government, the county is going to tax you on whatever you put in that section. So make sure you put it in the right parts of the return. And I've seen people just put all their assets in one section, and assets that are not even taxable, they're overtaxed on it. So there are certain penalties. There are certain penalties for not filing the annual tax return in the state of Maryland. Of course, there are late fees involved, and unfortunately, if you just let things go for about 2 years, then they will forfeit your business. What forfeiting the business means is you're not allowed to do any business in the state of Maryland once your business is forfeited. So you have to make sure that you actually do these returns every year. I'm taking my time to really explain this because there are a lot of people who kind of just forget to do that personal property tax return, and they don't find out until like 5 years later, because they might have moved. Or the Maryland, sometimes they just don't send you the notice saying that you have personal property tax returns to do. I think they try to save money as far as mailing things out. So you might not always get that in the mail unless you specifically request. Now I believe that you want a reminder every year that your personal property taxes are due. So again, they can affect your ability to open up bank accounts, and they affect your ability to get contracts, because when you get when you try to get these contracts, they want you to prove that you're in good standing in the state in which you reside. So they may just ask you for a certificate of good standing, but if you don't have those personal property tax returns, i.e., annual reports, then you will not be able to actually get that certificate of good standing. And I'll talk about that in a few minutes. So this might be a good segue to really take a break. Again, let me just rehash. You need to do the personal property tax returns every year. So let's take a break, and I'll be right back.
Hi, I'm Troy Emery. Here at TD Emery & Associates, we offer a wide variety of business tax services for small and large companies, including corporations and partnerships, nonprofits, and real estate taxation. Also, we offer audits, compilations, and reviews.
Let our knowledgeable staff at TD Emery & Associates help you optimize your tax benefits today. Dependable, accurate, trustworthy. TD Emery & Associates. Dependable, accurate, trustworthy. TD Emery & Associates.
What is this? The IRS?
We know that your tax preparation requires more than just the basics.
Hi, I'm Troy Emery, and I've spent my entire professional career helping taxpayers in a variety of tax issues. Let us show you how to confront and solve tax issues with every viable option under the law.
Call the tax team at TD Emery & Associates now.
Okay, we're back. So I wanted to start off with some of the issues that I've seen over the years as far as these personal property tax returns are concerned. I mentioned a few of them a little bit earlier. I'm just going to rehash a bit. So a lot of times you're just unaware of the filing requirement. You started the business yourself, or someone started it for you, and just, you might have forgot that you have to make these annual filings, or you just never knew about those annual filings. So some people, they don't file for multiple years. I kind of talked about that, and not including assets, that the right assets on the forms. So just to give you an example, if your chairs are worth $1,000, your leasehold improvement is $2,000. When you fill out the tax return, you are going to put the $1,000 for the chairs on the personal tax return, but you're not going to put the leasehold improvement on the tax return, because the leasehold improvement becomes a permanent fixture, or almost a permanent fixture of the real estate. If it's very difficult to actually detach from the real estate, then it is not tangible personal property, right? So that's the way that you want to look at that. Now, forfeited entities. I'm going to take a minute and explain forfeited entities. Forfeited entities happen in the state of Maryland when you don't file those tax returns for multiple years. It's usually about 2 years, so they give you a very short window here. So you find that you go online and you find that your entity has been forfeited. So the problem that this presents is if you've gone, say, 7 or 8 years, 6 years, whatever, and the business has been forfeited, then there is a way to actually reinstate your business. You have to fill out a reinstatement form, but the problem is you have to do a personal property tax return for every year that you missed. Now, the problem with doing that is you have to pay that $300 for every year that you miss, along with the reinstatement fee. So, you're always faced with the challenge of, do I just let this business go? Let me just let it stay forfeited, and I just create a whole new business, which you have the right to do. Just because you have a forfeited business doesn't mean that forever you're banished, and you won't be able to do business in the state of Maryland, and they won't. No, it doesn't work like that. If the business is forfeited, you no longer have the right to the name of that business, and you can't do any business in the state of Maryland until you get those personal property tax returns in. So what you can do in this case, so if you missed filing for 4 or 5 years, and you haven't really done much in the business, but you just kept the business name just going, right? And you just haven't filed, you didn't file in 4 or 5 years, and next thing you know, you get this contract, or you want to start using the business. Well, you're going to have to make a decision. Do I just let the business go, or just start a whole new business? And when you start a whole new business, you could just change the name just slightly, and you got a whole new business. So some people that they don't have the luxury of starting a whole new business, and then some people are. So let me give you an example of both. So if you are, this is a case for someone who cannot start a whole new business. So if you're a government contractor, for example, and you've used to having a certain name, and the people know you in the government space by a certain name, and you don't do these personal property tax returns for 3 or 4 years, and then next thing you know, you can't get a contract renewed, or you need to have this thing cleared up at the state and have a business that is in good standing, then you don't have the luxury to start a whole new business, because your history is with the prior business. And in government contracts, you have to make sure that you maintain the prior history. So it's not like you could start a whole new company, because it would not have prior history at that point. So in that case, you would have to pay the $1,200, $1,500. I've seen cases where people owe over $2,000 just to reinstate their business. Now, the person who that really just says, okay, just forget the old business and let me just start a whole new business, he might change the name just slightly. He can put the in front of it. He can change the spelling a little bit, or whatever, right? And that person, they just pay the fee to actually start the business, $150 or so, and he just moves on. He's not paying all those other personal property tax returns. So something that you got to weigh if you actually get your business forfeited. All right, so I already talked about this. You can reinstate and file past filings, or you can just start a whole new business. All right, so now let's do this for a second. Now that I've talked about these personal property tax returns and the annual report, let's just look at one, and I can kind of walk you through it real quick. Let me see. I got it here somewhere, so let me try to bring it up. Give me a second here. I had it all primed here, and I think I lost it actually. Let me just try to find it real quick. I had it here. Give me a second. I don't know why it closed. Let's see, seminar docs. Oh, office notes. Anyway, so it's 2 different forms that we're talking about here, and one is the annual report, and one is the personal property tax return. Let me see if I can find it real quick. Man, I had it all ready to go. Okay, here we go. So the top of the form just basically goes into the type of entity. Remember, I said you can be a foreign corporation, a foreign limited partnership. So you'll see here at the top whether you're foreign or not. You got a foreign corporation. This doesn't mean, again, that it's foreign from an international standpoint. It's just that you are not a business that resides in our state, so they say you are a foreign business. It has nothing to do with economics. I'm sorry, international in your geographical location. But anyway, you're going to put the general information on the actual return, and this is the annual report. And then these are the 2 questions I want to really talk about. Does the business own, lease, or use property in the state of Maryland? If you check that as no, and then you check B, does the property acquire or maintain trader's license in the state of Maryland? Then you don't have, if it's no to both of those questions, you don't have to fill out the personal property tax return. So if you see here, the annual report is just the first 2 pages here. So if you didn't have any business, you didn't have any property that you own, lease, or use in the state of Maryland, you can get by with just filling out these first 2 pages. Now, I do want to say something. I'm showing you this. This is the native form if you want to mail the form in. Now, if you were to go online, you could actually fill out these same questions online. I think the online app is a little easier than doing this, because once you fill it out, all you have to do is hit submit, pay your money, and you're done. Here you got to put something in the envelope, or you got to walk it down. You have to take it to the state of Maryland or whatever you're going to do to get it into the office. But here is the personal property tax return. It's going to ask you for general information. I'm not going to get into that. But the part that I was really talking about earlier is this is where you put your assets on this form here, and it's based on when you actually purchase the asset and the type of assets. So most assets are going to go into this column A here, and these column A assets are depreciated at 10% each year. D is for computers and whatnot, but most of your assets are going to be in column A. If you have a column D, you have to describe what B through G are. You have to describe exactly what those assets are. And then this is the part where I was talking about the inventory. This is where you want to put the inventory, but you're not really taxed on the value of the inventory. You're taxed on the sheet that you have here. So this is the most important thing here because, like I said, whatever you put on this form goes to the county. So if you were to put that you purchase, $10,000 of an asset in 2019, then the county is going to tax you on that assessment. So, and every year it's going to go down by 10% if you put it in column A. So here you're going to report this whole form here goes to the state of Maryland again, and then the state of Maryland looks at the county that you reside in, and they send your valuations to the county, and the county applies the rate, and they send you a bill. So that's basically how it works. There was one other thing that I was going to show you, and that's where you actually, so here it is right here. So this is what you do. You actually fill in where your business actually resides, because this is the place, this is the county. Whatever you put here, your county is going to get notified. So make sure you fill this out the right way. And if you live in an incorporated town in the state of Maryland, an incorporated town is a town that basically, the easy way to put it is an incorporated town is a town that has its own government, its own municipality. For example, Greenbelt, for example, that's where our office is. They have a Greenbelt police. So a incorporated town has its own police department. It could have its own fire department. They have their own government. So in our case, we would have to pay basically 3 taxes in the state of Maryland. We have to pay that $300 tax from the personal property tax return. We have to pay the county tax, which is Prince George's County, because Greenbelt is in Prince George's County. And then we have to pay an assessment on our assets to the city of Greenbelt. So that's 3 different taxes because we're located in an incorporated town. So let me just move quickly and wrap this up. Let me go back here. That's the basis of the form. I didn't want to get into every little thing, but that's the personal property tax, and I just want you to be aware that you have to pay annual fees or fill out an annual report for every state that you actually have a business in. Some states don't have a fee, but in most states they do have a fee, either annually or biannually. So if you have any questions, you can actually contact me at Troy_Emery at tdecpa.com, or you can call us at 301-474-1040. Or if you have a topic that you want us to discuss, just let us know, and we can actually do a topic on that as well. I hope you enjoyed today's talk. I hope it's really helpful for you in the state of Maryland. Anyway, be peaceful. I'll talk to you next week. Looking forward to it. Take care.